Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
So it's a great way to get a relative attractiveness of an option. That doesn't mean that I know that options are cheap or that options are expensive, but I can, because again, I might be comparing it to some other period of time, but again, I can get sort of a general view. So for example, way back right before the credit crisis, if you take, and I took these numbers from the Federal Reserve Bank in New York, the euro was trading in about a 4.7 vol, yen 6.6, the British pound was 4.8, and the Canadian dollar was 7.8, the Aussie dollar was 7.5. So those are some of the, some of the largest currencies. Then 1 year later, euro trading about 8.7, Japanese yen 11.9, British pound 9.5. The Canadian dollar was trading 13, and the Australian dollar was 13.6. So that was November 30th, 2009. It was 2007, 2009, 2007 a little bit later. And then in 2009, just a couple months ago, we had euro trading at 11, yen trading 14, British pound 12.3, Canadian dollar 14.6. And look at Aussie. Aussie was trading at 15.2. So that was really the riskiest currency pair. And so that's every day. If you're watching currencies, I want to know which is the riskiest based on the options market. I want to watch that. So every morning I look at what's going on with the AUM and AUX. Of course, now we've added the Brazilian Real, BRB. Those are important factors in the options market to understand where the pricing is going. All right, so let's get back to the pricing. Here I used I volatility, but again, another great place to go is live vol. So it's either a place. You would just actually type in European because it's a European style option. You put in the strike price 105. I'm sorry, the price of 105. The strike was 103. I did this a month or so ago, so I was looking at the January options with 37 days left. I typed in a 13 volatility, and I used 2.4% interest rate by a 1% by 0.10 interest rate. Came up with essentially the option prices. And I tried to line them up. So that day, the calls were trading about 3. I got them to be worth 306. The puts were worth 82. So I tried to line them up. And I also got the delta, which means that this option for $3.06, if the U.S. Canadian was going to move up by 1 point the next day, that option was going to gain about 70 cents. It would also change the delta by about 7 cents. So your new delta would be 77. Your time decay would be about 3 cents. Volatility exposure would be 11 cents. And then your row would be 0.07. So looking at the 105s, I could actually look at right at the money. I could say, okay, these calls and puts are going to be worth $1.84. Dollar was really trading at $1.85, $1.60, really trading $1.61. The 107s, well, the 107 call is worth 103, and the delta was about 35. So the deltas are, as we move up in strike price for the calls, deltas are going to be lower, right? We had 53 here. And we had 70-something here. So that's how you actually use a calculator. So when I get back to options pricing, I can use a calculator and see the risk of, A, holding an option, and if it moves against me, my delta is going to tell me what my exposure is. My gamma is going to tell me how quickly my delta is changing. Theta is going to tell me my time decay per day. Vega gives me my exposure to volatility. the trading is based on forecast. So I might want to buy the 100-103 call spread. Well, actually, I had different strike prices, but here I might buy the 100-103 for $1.20, or I could buy the 103-100 put spread for $1.80. All FX options pricing inputs are important, but the most important are volatility and the cost of money. Getting back to another term called forward pricing. An interest rate is nothing more than a mathematical relationship that maps a present value to a future value or vice versa. So the interest rate differential for currency pairs may create a different forward price relative to the spot price. So what it tells you is that, let's say the Australian dollar is trading at a 4% and the U.S. is trading at 1%. Well, the options are going to reflect that. They will definitely reflect the interest rate differential. Now, it's much different than in the spot market where every day, if you're long or short an option, you're going to be paying an interest rate, or you're going to have an offset each night. The options market doesn't work that way. The options market, when you buy an option, that all gets factored into it. And, of course, when you sell it, it's all factored in there also. So, to me, it's a lot simpler. If the base currency is higher than the contract currency, the puts are going to reflect it. The puts would be a bit higher. The cost of carry for equity options compared to forward pricing. Essentially, the cost of carry for an equity is equivalent to forward pricing. So if you ever traded equity options and you were long a company that was paying a big dividend, well, the put is going to reflect that because you're going to bring cash into your portfolio. Same thing in the currencies. If you were long the Australian dollar against the U.S. dollar, AUM, the puts are going to reflect the AUM paying you a greater interest rate by the put valuation being a bit higher. Volatility is really important, as I mentioned, because if the volatility is lower, that essentially means that all option premiums, especially the ones that are at the money, would be suppressed a bit. If volatility is higher, it means we expect more movement, and all options are going to be worth a bit more. So different strike prices are affected differently by changes in that perceived volatility, and that's vega. The longer the time period, the greater the impact of the vega. Implied FX options are considerably lower than equity options. Makes sense, right? Because we're not going to see a takeover in a certain currency, although we've seen a lot of action recently. But you're not going to see something where this, a lot of times you see a stock might move up 20, 30, 40, 50% overnight. That's not going to happen in the currency market. So that's why volatilities are much lower. So different volatilities. I might look at the CDD and I might say, okay, well, it's trading at a 13 vol. That's right here. But what happens if it goes to 16 vol? Well, if it goes to 16 vol, you'll notice that all the options, well, I just looked at the 105 call and put are worth more. So if the market is expecting more movement, option premiums move up. Conversely, if the market is expecting not much movement at all, you're going to see option premiums decline. And that's what we've seen in the U.S. dollar Canadian, is that the Canadian loonie has actually been moving a lot like the U.S. dollar. So any of us had forecasted that 5 or 6 months ago, you might wanted to sell some options because, again, if the Canadian's moving just like the U.S., that means the net is not going to be moving. They're both moving the same way, then the actual pair value doesn't change all that much, and therefore volatility might contract. So it's important to understand that when you're looking at option strategies, you might want to look at a couple different volatilities to see what-if scenarios. What if I'm right? What if I'm wrong? What happens when volatility changes?
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.